You know, the Federal Reserve met this week to discuss what's next. They have kept rates near zero. That came to a surprise to no one I've talked to. Now, my question to you, Lyn, is when could they expect, or when would you expect them to raise rates?
So far what we're seeing is that they're sticking to their plan. And so regardless of whether or not someone likes their plan, that's what they're sticking to. And so far that their plan is basically that they changed their inflation policy somewhat in the sense that they want to have average inflation targeting. So rather than treating their 2% more like an upper, kind of like a ceiling where they start to kind of get concerned, they're basically pointing to the fact that according to the way they measure inflation, they undershot it, the past 5 years or so. And so now they want to mildly overshoot it so that they look back and have, roughly average 2%. And so basically their policy is to not front run inflation expectations. So if they see inflation coming, they don't plan on kind of preemptively hiking rates to deal with that. And so they've described it as they want to see inflation kind of over 2% for a considerable amount of time. And so basically they're aware that we have upcoming base effects. So already March, inflation was over 2% year over year. CPI at least was more than 2% year over year compared to last year. And the April, May, and June numbers are going to be higher because you're comparing to a very low inflationary period of last year, which was the heart of the shutdowns. And so with all the fiscal stimulus in the economy, with reopenings, and with those base effects, we're going to get pretty high numbers. And the Fed is, they're kind of trying to control the narrative by pointing out that, in their view, they'll be transitory and that they don't plan to, do emergency hikes right away. But I think, with the inflation coming down the pike, I think they're starting to gently, tell people that, the tapering is potentially on the horizon, rate hikes are potentially on the horizon, but they're not getting to them very quickly until they actually see persistent inflation the way they measure it above 2% for, a period of time.
Could that happen anytime this year?
Well, so it depends. They've been kind of vague about what they mean by a period of time. And so we have to assume that both magnitude and duration matter. And so some of the magnitudes that people are forecasting with models are rather high for this late spring and early summer period when you have the combination of those base effects and all that fiscal response. And so if they blink, it's possible they could pull forward some of their tightening due to magnitude more so than duration. On the other hand, if they hold firm and kind of look through those few months, inflation could then go back down, at least again the way they measure it, could go back down to that 2 to 3% range, and they might be willing to hold that for a period of time. And so basically there's an order of things they could taper. So before they hike rates, they probably would start dialing back their asset purchases. They're still purchasing treasuries and mortgage-backed securities at a rate of about $120 billion per month. And so they could start dialing that back, to 80 billion to 40 billion, before they look at hiking rates. And the longer term problem with hiking rates is that there's so much debt in the system that every time they hike rates, they basically start running into a credit issue. And so I think even when they get to the point where they have to hike rates, that's going to cause issues, and it might have them reverse course probably faster than they think. I don't think they're going to get to a period of normalization anytime soon.
Let's take a look at the other side of the coin now. The other mandate that the Fed has is full employment. As you know, the unemployment rate has come down steadily since last year. It's currently at around 6%, non-farm unemployment rate. Now, one metric that the economists look at is the non-accelerating inflation rate of unemployment, otherwise known as NAIRU. Now, NAIRU measures the unemployment rate at which inflation stays constant. So do you think that this is a measure that the Fed cares about, and do you think that the unemployment rate needs to come down even further before inflation stabilizes?
Well, so what they're basically doing is they're focusing on multiple metrics, including broader metrics of unemployment. So Powell's actually cited some of these broader measures, and so they're taking a pretty conservative view about that. And so basically between their two mandates of price stability and employment, they're full on in the camp right now of trying to emphasize employment. And so that's why they're willing to let inflation run hot in their view if it means letting employment kind of rebound. So even though the official unemployment rate has come down somewhat, if you look at, say, the number of jobs in the economy, we're still very, very short of what the total number of jobs were pre-pandemic. If you look at the labor participation rate, the employment to population ratio, and broader measures of people that are marginally attached to the workforce or underemployed. So if you look at those broader metrics, we still have a long way to go to get back to the jobs that we had, prior to the pandemic. And that, jobs are generally a lagging indicator that they're some of the slower things to rebound. Whereas, retail sales can bounce back quickly, GDP can bounce back a little bit after that, but jobs are kind of a longer term thing. And so that's why they're trying to be more accommodative, to basically, they're trying to have that pro-inflationary, pro-job growth environment, and they're willing to kind of make that sacrifice on the inflation side. And so that can, obviously be an issue for people that are invested in cash or invested in bonds.
We know jobs are a lagging indicator. Let's talk about something that isn't lagging, Lyn, which is prices of markets, valuation levels. Now, you've written an article recently, a fascinating read. I encourage everyone to check it out on lynalden.com. It's about market capitalization, and you've listed a few examples of various asset classes and how, according to you, their value. First of all, why don't you help us define market cap in your words, and how this relates to current valuations right now?
Sure. So the market capitalization of a company is the number of shares multiplied by the price of those shares. And so basically it's the theoretical value of the whole company. And then if you extend that and you say, what is the value of all publicly traded companies? Then you basically get an idea of what is the full value of the market. And then you can compare that to other large economic indicators like GDP and say, okay, what do asset prices look like compared to the size of the economy? How much economic output we have in a year? How does that compare to asset prices? And of course, that's one of several valuation metrics. So you can also do the cyclically adjusted price to earnings ratio. You can do price to sales ratio. There's a variety of different metrics you can do. And it's often good to use multiple metrics because they help kind of, fact check each other. And so one thing we've seen is that in over the past year, we have a record high market capitalization to GDP ratio in the United States. And so that's not the case in many other countries. But in the United States, we've had, we've reached very high valuations, even higher by that metric than the dot-com bubble. And so that's interesting because most metrics show that we're probably the second most, expensive ever. If you look at the cyclically adjusted price to earnings ratio, if you look at, dividend yields, things like that, we're roughly second to where we were in the dot-com bubble, but by a couple metrics like price to sales ratios and, market capitalization to GDP, the United States has never been more expensive than it is right now.
In your article, you talked about Bitcoin, gold, and equities. Before we talk about how market cap applies to gold, I like to just first ask you, generally speaking, which of these assets that you've discussed in your article do you think is the most overvalued?
So by most metrics, I mean, equities are more overvalued than other asset classes. Gold historically is there's different metrics that show, by the most conservative metrics, it's undervalued. By more aggressive metrics, it's maybe fairly valued. And so, for example, if you look at gold compared to other commodities, still you're generally on the more pricey side for gold. If you look at gold, how many ounces of gold it takes to buy the median house, you're still looking a little bit more on the pricey side for gold. But if you're comparing gold to the amount of broad money supply in the system, if you do it on a per capita basis, or if you take into account, gold's inflation rate, basically the mining rate, that's about fairly valued. If you look at, for example, how much gold the U.S. Treasury has compared to the money supply, that's very cheap by most metrics. Basically they have a smaller percentage of broad money supply backed by gold, indirectly, than most times in history. So there's a range of different metrics, but overall, gold's not too frothy at the moment, especially after the 8-month correction that it's gone through.